Just a little bit about myself. If you're not already bored of this slide, I am Raj Teksadani, host of this webinar. I am a techie turned full-time real estate professional. I have a passion for leveraging data. I did that in my technology job and brought that on to the real estate world. I bought my first condo in 2012 and subsequently bought 8 more over the next few years. I bought my first multifamily because that was a better way to do things, and we'll know more about it, in Massachusetts. My first passive investments was in an apartment complex in Dalton, Georgia. Since then, I've invested in over 650 units. I've invited on multiple podcasts. I manage a couple of Facebook groups, if you don't know about. One's called the Data Driven Real Estate Investing, and the other one is called Apartment Investing and Multifamily Syndication. I'm also the member of the Forbes Real Estate Council, and I published a free email course recently on, which is called 8 Pieces of Pie, PIE standing for Passive Investor Education, and some other guides this year. Here is some of the things that I published. Like this, you see the 8 Pieces of Pie, and all of these you can find on my website, smartcapitalmanagement.com. I also had something called 99 questions to ask before investing in real estate syndication, which Jeremy can write multiple books on, but we'll go into that a little more. About our host, Jeremy Roll. Jeremy Roll, I have been watching and following Jeremy Roll for a while. I'm absolutely impressed with this guy. Every time I listen to him, I gain more and more knowledge. And I listened to him recently, and I said, Jeremy, you need to come on this show, basically as for passive investor. Jeremy started investing in real estate business in 2002. He left his corporate world in 2007 to become a full-time passive cash flow investor. He is currently invested in over 60 opportunities across $1 billion, that's with the B, worth of real estate and business assets. As founder and president of Roll Investment Group, Jeremy manages over 1,500 investors who seek passive managed cash flowing investments. He's also co-founder of a group called For Investors by Investors, which is a nonprofit organization that was launched in 2007 with the goal of facilitating networking and learning among real estate professionals. As you can see, Phoebe is now the largest group of public real estate investor meetings in California with over 30,000 members. With that, I want to welcome Jeremy, and I'm going to do like I said, this is going to be different. Jeremy doesn't have any slides. We decided that we'll just keep it as a fireside chat session, make it more interactive. So I'd love for all of you on the call today to, ask questions, and we will take your questions as soon as they appear in the Q&A box. So I'm going to stop sharing my screen here and get back into the conversation mode. Jeremy, do you see my face?
I do. Thank you. And thanks for having me on. Really appreciate it.
All right. Thank you. Thank you. So once again, thank you, Jeremy. So let me start off by, as I was first introduced to Jeremy Roll is a professional passive investor. And I was fascinated with that term. And tell me, so I've read a brief bio of yourself, but why don't you add a little more color to what I just read out in your own words?
Yeah, and again, thanks for having me on. Really appreciate it. So let's see. I would say just quick higher level background, which is, I started investing in passive opportunities, mostly syndications, but not all of them, where they group a lot of investors together into, one opportunity. That started in 2002, and the reason why I got into that was it was after the dot-com crash, which I know was a long time ago at this point, but it was really as a result of 2 things about the dot-com crash that really bothered me. One was a lack of predictability of, where my retirement account was going to be in 10, 20, 30 years, and not really knowing that just was not the right retirement strategy for me. I'm a really slow and steady guy, but I'm also very planned, and it was really bothersome to me. The other, of course, was the volatility. To watch the stock market go up and down 30% in a year is just not the right fit for someone of my risk profile. So that's how I got into all this. And interestingly, I think a lot of people, I'm guessing, would assume that when I got out of the corporate world in 2007 from the cash flow, that it was this great plan that I had to actually, rotate all my money from stocks and bonds, build up cash flow to leave the corporate world. But in fact, what I wanted was a paycheck and the cash flow. The cash flow was just meant for more predictability on the retirement account side. But I had a last straw moment with my corporate, with my manager in the corporate world. It was working at Toyota headquarters at that time. I decided to take a risk and leave the corporate world from the cash flow. So to your point, I've been what I call a full-time passive cash flow investor for 13 years now. It was actually 13 years last month. But I've been investing in these types of opportunities for about 18 and a half years. So it's getting close to 20 years. And I kind of am hyper diversified. I don't even necessarily recommend the level of diversification I have, just because I do it full time. So I built up a big network to find a lot of opportunities, but I'm in over 60 LLCs right now. I've been easily in over 100 in the past 18 years. In fact, I was in over 30 sales in the last 3 years alone. So, so it's a lot of work because I'm in so many different things, but I just love diversification for so many reasons. And so that's my quick background. The one thing I will say is that, and I hate mentioning this, but it's important. Like, I don't want to sound like an infomercial because I have nothing to sell here, but the cash flow really changed my life. I can give you multiple examples, but, and not the least of which is getting out of the corporate world. I mean, it just changed everything about my life in very positive ways. And I'm just extremely thankful for the cash flow. My number one focus is to continue to build my cash flow snowball bigger and bigger, so I never have to go back to the corporate world. That's really, even 13 years later, that's still my focus, is to not go back to the corporate world. So that's kind of my higher level background.
That's awesome. That's awesome. It's amazing. And one of the questions that was already asked is Jeremy's portion of equity in the deals $1 billion, or the total property's value is $1 million?
Yeah, great question. So let me explain that number. My portion is tiny of each deal I invest in. And in fact, I purposely put small pieces across a lot of deals for that diversification. And the 1 billion is actually understated. So that's the total value of the assets of what I'm investing in, right? So if I invest in a $250 million fund and I put X amount of whatever it is inside, I'm just a tiny fraction of that ownership. In full disclosure, I mean, I'm in one opportunity alone that has a current value of probably $1 billion. Is actually a startup. And I have a handful of startups, like 10 startups. That's like the 1% of my focus. And then there's there's a very large mobile home park fund that I'm in that's probably got a value of about $300 to $500 million on its own. So I just used $1 billion generically, but that's actually the total value of all the assets.
So Jeremy, I know you have had you've talked about this art and science of due diligence, right? I mean, how you have done it. Why don't you give us, our listeners here, what does due diligence mean for you? And we'll get into different components of it. There is a syndicator, vetting the syndicators, operators, the deal itself. So, but let's get started on what you coined the term as diligence as for passive investors.
Yeah. So the first important thing to note, and by the way, I should have mentioned at the beginning, so I know you mentioned, I'm not an investment advisor, so anything I'm sharing here is just my perspective as an investor, right, for everybody out there. So the first thing, important thing to note is that probably one of the biggest lessons I've learned in the 18 plus years is who I'm making a bet on is probably more important than the property. And I know that's subjective, but that's my opinion. I think that the property is a very close second. The property is extremely important. A lot of components about the property are very important. But I think who I'm making a bet on is even more important, because I tell people that when I invest passively, I trade control for diversification. And I try to get diversified across asset classes, geographies, and operators, all three. But the point is I'm giving up control. And that means that I'm allowing someone else to make the day-to-day decisions. There's no way to get rid of what I call the 1% risks, which are a lot of things that are not able to be forecasted, but not only the non-predictable risks, but even the fraud, mismanagement, Ponzi scheme, you can never get rid of that risk 100%. And so I focus on who I'm making a bet on as part of my due diligence very intently. And there's a couple different ways I do it, in more tangible and intangible ways. And that's where it becomes, that's why you're mentioning, it's kind of like a combination of art and science, right? The science piece is the numbers. The art is, reading between the lines, like, who am I really making a bet on here? And what is your gut telling you about whether you should be actually making a bet on this person or not? I know we're going to get into a lot of this, but that's really high level. My number one takeaway is who you're making a bet on is just so important.
Yeah, absolutely. Because I think sometimes they say that a good operator can make a bad deal look good, or make it good, or a bad operator can make a good deal go bad. So
yeah, I use a very easy example, right? So I'm currently in LA. I live in LA, and I live a few blocks south of Beverly Hills, and I'm sure a lot of people here know Rodeo Drive, very fancy, like famous street, right? Very high end property. I tell people, look, I can invest in the best location in the middle of Rodeo Drive with the best tenants, but if the operator, mismanages it, runs it to the ground, screws up the relationship with the tenants, and the building goes vacant, the keys are going to go back to the bank, and none of it mattered that it was the best location in the, with the best tenant mix on Rodeo Drive. And so that's a really easy example as to why it's so important who you're making a bet on.
Absolutely, absolutely. So getting into that first phase of, sort of passive due diligence, which is, even when I wrote the e-guide on 99 questions, my first section was on operators, right? How do you vet an operator? It's not an easy thing. And I know you talked about a lot of background checks, but I want to have my listeners here get it from you directly.
Sure. So the first thing I'll do, and by the way, I don't have notes, so I'm just brainstorming, but the first thing I'll do is I will try to weed out a deal, because the vast majority of deals I look at are not a fit for me. Now, it could be that it doesn't fit my box, meaning I have specific parameters, and I'd recommend for anybody out there, if you're new or even experienced, the smaller the box that you create for yourself, meaning the more specifically targeted you are, you're going to end up saving more and more time. Because for me, if a certain asset class isn't hitting a certain cap rate or a cash flow target, or if I think the exit cap rate's unrealistic, or let's say there aren't enough, like I love diversification, right? So if you bring me a 10-unit apartment building, it's not going to be a fit for me. It may be fine for anyone else listening to this, but it's not my criteria, right? So if there's not enough tenant diversification, there's a lot of different things that I can weed out immediately. And that helps me to like put stuff into the garbage, because the reality is that the vast majority I will look at is not going to be a fit for me. And you can weed a lot of stuff out very quickly. And it's interesting because we're now in very interesting times, right? So we're in the middle of a recession. But if you would have asked me a year ago at the end of a cycle, I would have said, look, 99% of what I'm looking at isn't meeting my criteria from a numbers perspective just to begin with. Easy to weed out, right? So even now, I kind of still have that opinion because I don't think we've seen the effects of the recession quite yet. And that's a whole different topic. But so getting your box to be as small as possible and as well-defined as possible is really going to serve you well over time. And I know that takes a lot of time and thought and education, but it's really worth the effort, I think. It'll make your life easier on the due diligence process. Now, let's assume that I get a package and then actually everything, the numbers, the high-level numbers you can really target quickly seem to kind of check the boxes, right? Then what I'll do is I'll actually get into much more detail and start reading the pages about what the business plan is. I'll give you an example. I'm pretty low risk. And so the most I'll do in value add may be like, let's say if they're going to rehab, we're going to rehab the units on a 200-unit apartment building, but we're only going to rehab them when the tenant decides not to renew their lease. So if somebody's in there and they renew for 3 years in a row, we're not going to force them out. We're going, because the cash flow is still going to come. We're going to do it very measured, very paced, and there shouldn't be too much cash flow disruption. The focus will be more on maintaining the cash flow and the occupancy as opposed to maximizing the value as quickly as possible. So if somebody has a business plan that says, look, we're going to rehab all the units, but we're going to, as soon as leases are over, people are going to be forced to move out, and they may go into a new one that was just refreshed, right? And they'll have to pay the upgrade, but we're going to force people out at the end of each lease and get the stuff turned as quickly as possible. That doesn't sync up with what I look for on the risk profile. So that the business plan isn't congruent with what I look for example. So it's really important to look at the business plan. And also, if you're looking for a Class B asset to invest in, and the business plan involves buying a Class A or a Class C asset, or even maybe taking a C to a B, but you don't agree that that type of building structurally or even age-wise will really ever get to a B, you may want to pass, right? So looking at the business plan after the numbers look okay is very, very important to make sure it's syncing up with what you actually agree with as a philosophy as an investor. And again, if this sounds complicated to you, I think it's important to note, if you're new, that, A, that's okay, but B, it's important that you hone in on what you're looking for, because you'll prevent yourself from ending up investing in stuff that you didn't even realize you shouldn't have invested in because you didn't take the time or didn't understand well enough yet to really understand what you're most comfortable with. It all comes down to comfort level with whatever strategy you're targeting, right? So then I'll read the business plan and make sure it really syncs up with what I'm looking for. I'll look at the location and make sure I'm comfortable with it. Location is very important for multiple reasons. I invest in a lot of asset classes, so I'm going to give you some random examples. If there's a mobile home park in upstate New York, very unlikely I'm going to invest in it because pipes can freeze, that can cause all kinds of problems, and I don't really have to invest there if I don't want to, right? If I'm looking at a deal that is a 400-unit apartment building on the shore, like of Miami Beach, and I don't really love the idea of the hurricane risk because that's less predictability, I'm going to pass on it strictly because of that location. If you would have taken that property and put it in Texas and Dallas, I would have considered it, right? So there's a lot of different factors at play, even just from a weather perspective, and each asset class is different. So like with self-storage, I've invested in several properties in Florida And the reason why is because they're single story. The worst hurricane damage you get, because there's no real windows, is you might get the air conditioner on the top of the roof or on the bottom, maybe get some wind damage from something else hitting it. But all the tenants are forced to take insurance, and so they're self-insured. You know, you've got concrete floors, and the flooding isn't going to really affect you that much. So I'm okay with that. But again, would I invest in a mobile home park that can be swept away by a hurricane? Probably not, right? But also, would I invest in a mobile home park in Texas that's subject to tornadoes? Yes, because usually the probability of having a problem with tornadoes is much smaller versus a hurricane, and there's other reasons too, right? So it's important to consider the geography, and it's important to consider whether you think that that market that is being targeted will be high growth or low growth going forward, and whether it matches up with what you're investing in. So for example, senior living facilities, you know, a lot of, I believe it's going to be a great asset class for the next 10 years. And it's not the least of which is because population is projected to really grow, and demand, if you look at the numbers, is projected to really pick up in that asset class as of 2023 based on the aging population. But does it make sense to invest in a senior living facility? And I'm sorry I keep using this geography, just I'm from Montreal, so I know the geography well. Does it make sense to pick a upstate New York property that's a senior living facility versus one in Florida or Texas, which is the number 1 and 2 states have projected migration, you know, influx into those states, so the demand's going to increase, whereas in upstate New York, the population's been decreasing, right? So again, it doesn't matter that the population trend is there nationally, it matters where you are, right? The actual location. So as you can tell, you've got to really take a look at various components of the business plan and make sure you actually agree with the plan. Because just because someone else is buying that property, it doesn't mean that you agree with the reason why they're buying that property. And there's 1,000 ways to invest. None of them are necessarily wrong or right, but you want to make sure that it's syncing up with what you agree with. You know, if you're the type of investor who is just saying, oh, the numbers look good, I'm just going to go with it, then that could really increase your risk, right? It could still work out okay, but if you took a little more time to really define what you're looking for and learn a little bit more, you can help to reduce your risk. So this stuff's really, really important.
Yeah, absolutely right, Jeremy. You said it right. Absolutely. You have to come up with your criteria, not Jeremy's criteria, because I've seen investors who want to invest only for getting the tax advantages. They say, you know, they care less about the cash flow, but they say, you know what, I need to get the cost segregation. Does the deal have a cost segregation or not? And for people who miss on the cost segregation, there was a previous webinar on that. But just my point is that know your criteria.
Yes, so important. I mean, again, there's 1,000 ways to invest, and none of them are necessarily wrong. It's a question of what is best for you, right? Yeah. So once the business plan looks okay, then what I'll do is I'll create a very long list of questions that I have based on reading the entire business plan. Okay. Could be questions about the comps they chose, why they use certain increases in inflation on the expenses or revenues, why they chose certain vacancy factors, why they assumed a certain price on the exit. It could be for so many reasons, right? And that's going to be a combination of looking at the numbers, but it's also going to be, and this is where we get into the intangibles, it's also going to be a lot of reading between the lines. So I'm going to give you an example. I believe that if you read the business plan very carefully, sometimes it could tell you a little bit of who you're dealing with, right? So for example, if you have someone who's assumed that the vacancy factor is going to be 3% on an apartment building, okay, because it's a very high growth area and it's currently 100% occupied, and the next person assumed an 8% vacancy factor on that exact same building, I would encourage you to ask them the question, why did you assume 3%? Why did you assume 8%? Because what I'm looking for anyway is someone who's very conservative, who's looking to under promise and over deliver to build long-term relationships with investors and make investors happy and make it a great win-win proposition. Those numbers, though, are not going to look as good as the person who's looking to use very aggressive assumptions, making the numbers look really good from a marketing perspective, and doesn't necessarily care about whether you reinvest. They just want to close that deal and attract the, you know, the amount of investors they need. And I'm trying to avoid the person who's being too aggressive in their assumptions. And I'm trying to find the conservative person for a myriad of reasons, not the least of which is that it really matches well with my personality, right? And so in reading between the lines of what they're using, and even some verbiage, it could say like, you know, property is currently 100% occupied, but we assumed an 8% vacancy factor to be conservative. You know, that tells you something about the operator, but you can also ask questions so you can see the way they answer. So in other words, you may want to ask them, why is there an 8% vacancy factor? The answer you're hoping for, even though it's 100% occupied, right? The answer you're hoping for is exactly what I just told you. You know, we're trying to be conservative. The answer you don't want to hear in asking that question, instead of just assuming that it's because they're conservative, is, oh, well, there's a lot of construction coming along, a lot of units, competitions coming around, and we're trying to be careful with that. That's a good thing to an extent, but it tells you a lot about what's going on. But if the answer is, oh, we're just really being conservative, that tells you something about the personality you're making a bet on. Same thing with that 3% case, right? The person may say, look, we're using a 97% occupancy assumption because we're 100% occupied. The new train's coming online in the next year. There's going to be a lot of economic growth. We've just seen 5% economic growth each year for the past 5 years, and all these reasons. And they may be right, but it doesn't necessarily match up with my conservative, way of looking at things going forward. And I would just pass, right? And so it's important to ask the questions and to try to read between the lines on some of the answers. Hopefully that makes sense, but it's important to look at and to ask. So I'll create a very long list of questions. Typically for me, it's between 100 and 250 questions by the time I'm done. I'm really detailed. And that includes questions about the legal documents. By the way, that's not just about the business plan. For anyone on here who doesn't read the legal documents, I would strongly recommend you read the PPM and the operating agreement for very different reasons. PPM is typically a disclosure of fees and also the risks. Those are important to understand, and they may turn into a lot of questions that you may have. The operating agreement, though, I focus a lot of time on because that is the rules that the operator has to follow. And that's the rules you're agreeing to by subscribing to the LLC, right? So if you're, I spend a lot of time looking at those because if you're expecting quarterly reports, right, but the operating agreement doesn't say that there has to be quarterly reports. There may be reports from time to time. Or if you're expecting cash flow distributions every quarter, but the operating agreement says there should be distributions from time to time, which is, I'm using those legal expressions because it's frankly a very common thing I see. What that means is that if push comes to shove and you haven't gotten a quarterly distribution and you have to pursue this operator because they're not being kosher, you go to court and it says from time to time and you've got nothing to stand on because you agreed to rules. It just says from time to time, right? And that's one easy example, but there's a myriad of examples to do with reading the legal documents and making sure you agree with the rules. I'm going to give you another example. There was a deal I once saw. This is the most egregious thing I've seen on the cash call provisions, where it said the operator can request a capital call at any time for any amount, and whoever didn't provide the capital within 48 hours, okay, would be diluted by 50%. Okay, think about that. Let's say that they asked for $1 million for not necessarily a substantiated reason, and then you couldn't provide your share of the $50,000 you owed from that in 2 days, you would lose half your shares. That is not what a normal capital call provision is. That's completely egregious. And I can guarantee you that whoever subscribed to that deal didn't read the rules, because they could do that, by the way, for nefarious reasons. And then you take them to court or you pursue them, and there's nothing you could do because you agreed to those rules, right? So it's really important to read the operating agreement and see what rules they have in mind and make sure you agree with them instead of making assumptions. There's so many examples I can give you about that. All the way from like estate planning and whether you're allowed to transfer shares to when you pass away to your kids, to like, can you transfer shares to your trust without being knocked out of the opportunity, to, I mean, there's just a myriad of things in the operating agreement. So, and even if there's a cash call, how does it work? How long do you have to fund it? Is that going to be funded by the investors? If it's a loan, what interest rate would you get, or what interest rate would someone else get? I mean, I can go on and on, right? So, so I end up with about 100 to 250 questions on a typical deal. And what I'll do is I'll do two things with those questions. The first is I'll typically send them by email first, and I'll get responses. And then what I'll do with those responses is, what I like to do is anything that didn't really fully clarify the answer to the questions to me, I'll then schedule a call with them to discuss those things just to get more clarity. And what happens in that call is that I get to know the sponsor really well by phone now, right? And I suppose you could do video if you wanted to. And now I'm starting to like be able to get a sense of who am I making a bet on. I've already seen some of the answers. I've already seen some of their philosophy and reading between the lines and the way they answer the questions even. I'll get even more in-depth, intangible information about them by having that phone call. From there, assuming I got all my questions answered, I'm pretty satisfied with them. I won't invest with someone unless I've met them in person at least once. And I realize that that's not realistic for everybody, because I do this full time, so I can get on a plane and go meet somebody. But it's a thing, it's a rule that I have, because in a way, in the end of the day, between background checks that I run, all the questions and everything else, again, I'm giving someone control, and the gut check is also what I learned is so extremely important. And I cannot get a full gut check, in my opinion, until I've met someone in person. And so one thing that's really important about the in-person visit is I always try to do it at the property and have them tour me at the property, because I think that gives me another hint of how detailed this person is, how detailed they were in actually doing their due diligence in a way that's very different than the business plan itself. And I'm going to give you a really good example of how I have two different types of due diligence trips, which have two different messages that I get from them. Okay. So, and I'm sorry, this is a really long answer, but I'm giving you like the A to Z.
Keep going, Jeremy. There is tons of information here, and I'm sure people are waiting to take notes and get more out of it. Yeah. So keep going.
So when I get to a location, assuming I have to stay somewhere overnight, typically a due diligence trip can go one of two ways. Let's assume that it's a retail strip center, okay, and it's in like an area where there's a bunch of other retail strip centers. Either the sponsor will say, meet me at the property at 11 a.m. and I'll tour you at the property, and I'll drive over there and I'll meet them at the property. They'll walk me through the property, walk me through some of the actual stores, show me around the property a little bit, give me some insight, and then we'll be on our way and I'll get back on a plane. That's one take on it. The other take, which to me is much more preferable, is someone says, look, I'm going to pick you up from your hotel. We're going to drive over to the property. We're going to go for lunch after. Okay, great. I'm going to pick you up. I want to pick you up half an hour early because I want to show you some stuff on the way to the property, right? And then what happens is that on the way there, they're showing me around the area. They're actually giving me a tour of the area because they've gotten to know it so well that they're able to say, look, we're investing in the strip center. I want to show you some of the competitors as we're driving towards it. And I want to tell you why I think we're still going to actually do well and be competitive compared to those competitive strip centers that I'm going to show you, you know, both in terms of the tenant set, the location, and everything else. We may even drive through those centers while we're going through, right? And they'll point some things out. We get to the property, they gave me the tour, and sometimes you could tell how detailed somebody is by like to the point where they're saying, we noticed some cracks, you know, in the parking lot, we're going to take care of it. This is how we're going to fix it, you know, or we did an assessment of the roof, and this is what I want to show you, you know, these ICs have to be fixed or, you know, replaced or whatever it is. Different level of detail. And now you start to get a better sense of, oh, I'm making a bet on a really detailed person. That's a good thing, right? They take you to lunch. On the way, they show you more competitors. And then they sit you down and tell you a bit more about why they like the area, what research they did. They tell you about the fact that it's like in a capture market, and the surrounding locations are all developments that were built in the last 20 years. Of course, I'm making all this up. And then they'll take you back to the hotel and maybe show you some more stuff on the way back, right? You're walking away with a completely different impression of who you're making a bet on. And those are two very different trips. And I've been on both of them many times, frankly, to be honest with you. And so that's part of the reason why meeting the operator in person, you know, you walk away with a very different gut feel, but not even a gut feel. It's just a better assessment of who you're making a bet on, far beyond what a nice fancy package looks like that may have been put together by an analyst at that company, right? So that's why the trip is so important to me. And then background checks. I will tell you, that's a rule that I have. Every time I invest with someone, even if I invest with them 10 times, I rerun a check just to be sure nothing's come up since. And I do a ton of networking with investors, and my best guess is that over 95% of investors don't run background checks. I find it very rare when I hear somebody ran a background check. And I think it's highly unfortunate, because I could tell you right now, background checks have saved me multiple times in 18 years. I'm absolutely convinced. I mean, I remember once I saw someone who was raising money, who had lived in a certain state, had been sued by 40 people, and then they picked up and they moved to another state. And then within 2 years, they were sued by 20 other people. And I'm picturing myself, this guy's like running away from investors, finding a new network, and being sued by more people, right? It was kind of like obvious. And if you didn't run that check, you know, this guy may have been a great salesperson. That'd be the beginning and end of it, you know? So, and I mean, there's a lot of other reasons why it's important to run the checks. One thing I will say, a test that I do in the background check in terms of a personality test is I will always ask every single managing member, and I do want each managing member to give me their name, date of birth, and home address. And honestly, if it's not a common name, I don't really need any of that. But the reason why I ask for that information, just even to see how they react to giving me that information. I don't ask for the social because I think it's over the line. But you know, I'll see how they react and see if they're trying to hide something or not. And the most important question I ask, I say, look, I'm going to run this background check on you. Is there anything I need to know before I run the check? Very often, something's happened and there's a good explanation for it. I'm very open-minded to hearing it. And I come across a lot of really good explanations that people say, you know, I have a good example, like 17 years ago, I was stopped by a police officer for a traffic violation. They found a gun in my trunk, and it was actually my gun and it was licensed, but I didn't know I wasn't allowed to actually transport it in that area at the time. And, you know, really great to hear in advance until versus getting a background check that shows that somebody had a gun. You're like, what the hell is this person doing, right? It's important. On the flip side, though, I just happened a couple months ago, an investor called me and they said, ran a background check on a sponsor. I asked them that question, you know, have anything? They said, no, there's nothing in my background. They had a bankruptcy 12 years ago. I think the sponsor probably assumed that once it's wiped off their history in 7 years, it's not going to show. But a background check shows everything from the past. And they said to me, like, would you invest in this deal? Because I didn't mention it. And it's like, look, I mean, that's a pretty, like, you know, you don't forget a bankruptcy to tell somebody about a bankruptcy, right? So the question mark is, did they do it on purpose or not? Frankly, we didn't know the answer. But I said to them, like, why take the risk? Because, you know, they didn't tell them that aspect about their life, you know, to you, possibly to hide it. And there's so many deals out there, there's not much point in taking the risk, right? So that's why asking that question on the background checks is very important. And then once you've done all of this, that's when you get the gut check and you kind of decide, okay, you know, is this the right person to bet on? Is this the right deal to bet on? And I skip through a lot of steps. You know, you're going to want to look at like a lot of data they present as far as comps for market rents, comps for sales comps to compare that. Did they choose the correct comps or not? Do you agree with what they chose? You got to ask questions about that. Why did you choose these 8 buildings? And are they the closest comps or are they the most convenient comps because the numbers look the best, right? And you're going to want to dig into all that. To me, the entire process is trust but verify. But you really have to verify carefully. And if you're just going to trust without verifying, you're increasing your risk. That's kind of the way I would say it. So those are some high-level thoughts. And I'm sorry, I know it's a lot of information, but.
No, that's great. That's great. And I see a lot of questions also pop up. But again, I mean, there is like a lot of people just, you know, look at the first email, which, you know, the subject line says 20% IRR or excellent class B in a class A or class C in a class A. And people get excited with that. And there is so much more as you look at the numbers. What do you think about the underwriting? Do you ask for underwriting people? Some syndicators do not want to share it because they just think it's their secret sauce. Yeah,
that's a great question. So, you know, I'm a very big proponent of looking at every single line item. And I'm going to give you an example why that's important. Because again, it shows you how detailed somebody is. I know sometimes they don't want to share it. It can be hard for an individual investor. Hopefully they'll share like a PDF version. So you actually see the line items of PDF, but not the live spreadsheet. I like to dig into the live spreadsheet because I can actually run my own sensitivity analysis on changing, let's say, the end cap rate or changing the inflation rate. What effect would that have on, you know, on the actual returns? And by the way, Raj, I've lost you. Can you hear me?
Sorry, I just went off screen for 1 second.
Okay, great. Okay, I just want to make sure you. So I like to really dig into the details, and I'll give you an example of why that's important. Just a random example. I remember once I was looking at a self-storage deal, and you know, there's one way an operator can do it is say, okay, my inflation expense assumption increase is going to be 2.5% per year, and they just take it and apply it to all the line items all the way across the deal, right? Sounds reasonable. But I remember seeing one line item somebody had that said health insurance for the staff, for the members. And I looked back into some of the numbers and it wasn't 2.5%, it was like something like 8% or something each year. And I said to them, like, you know, is that an error or did you actually put that on there on purpose? And they said to me, no, like we see health costs going up, crazy inflation. And we think we've got to be conservative. We've got to assume it's going to go up 8% per year for the full 10 years because it's not realistic for us to plug in 2.5%, 3%. It's just not going to be realistic, right? So that tells you a lot about the operator. You know, they went through and really went through line by line. And, you know, if someone were to have that line now and it's not at 8%, you got to wonder, should I make a bet on this person? Because that's not conservative, right? And that's why it's important to have the line by line. I will say I have a bit of an unfair advantage because I have my own investor group. And even though most of the deals I invest in are for myself, I kind of have the leverage that somebody knows that I may take a look at that with my group later. And so I have a bit better of a chance of getting a proper like live spreadsheet from somebody than the average investor. So I get to look at pro formas probably every time. But again, if you're not going to look at the pro forma, in my opinion, you're not really being 100% detailed and you're possibly increasing your risk depending on whether you would have found anything or not. So Yeah.
Great idea. And there is so much importance to be paid on the assumptions, right? I mean, there's pro forma numbers are one thing, and the assumptions behind that is another thing, right? The rent growth in certain markets may not be the same as the other markets, right? So we have to do a lot of analysis there. So Jeremy, I'll give you a break and I'll look at some of the questions here. Unfortunately, there's people typing in both chat and Q&A, but I'm going to start with the Q&A box first because that was the rules. That was in my operating agreement that we'll start with. So let me just go sequentially, and they may not be in the order that you want to see it, but let's do it anyways. So Jeremy, the first question we had was, are you personally investing in multifamily deals right now? If yes, which markets?
Great question. So look, I'm one person's opinion, so I'll give you my opinion, but 1,000 other people may disagree. I'm really conservative. I've been mostly on the sidelines since the end of 2016 because of the cycle timing, and I knew that we were already getting very late into a cycle based on how long historical cycles last in the US. So I've been mostly on the sidelines for years now. In fact, just to take a further step back to give you an idea of how conservative I am. So back in 2009, when the cycle started, I was investing in apartments and they were really hot. I mean, people were getting foreclosed in their single family homes, and it was the most obvious asset class for demand in the coming years. It was just obvious that people would demand apartments more. So everyone was flocking to apartments. And by 2013, I kind of drew the line for myself and said, this is overheated. I'm at my maximum cap rate. That criteria that we talked about earlier. I have to drop off at the end of 2013 from that asset class and continue with the others. And that's how I work on a cycle. I kind of drop off an asset class when it gets too expensive and just continue with the others. And I probably invested in about 10 multifamily deals since then, but they've all been unique pricing. It was like, I have to get a unique situation from that time. So fast forward for today, and this is not just for multifamily, but for any asset class. The reason why I'm still holding off investing in general, I've been waiting for years to jump back in, and I'm very excited about the cycle timing, is because this recession, in my opinion, is currently delayed. That's the best way I can describe it. From the stimulus checks that have been printed so far, we haven't been able to get the typical dominoes fall that allow us to discover very important things. So discovery number one would be vacancy going up. Discovery number two would be market rents going down because of more supply of units from the vacancy. And the discovery number three is reduced net operating income profits from those properties as a result of reduced rents and possibly increased vacancy, right? And then discovery number four is, how do the cap rates or multiples adjust because people are scared there's a downturn as a result of what multiples are willing to pay for a property. And the concern I have about investing in anything today is that, let's say you get a 5% discount or a 10% discount on a multifamily property today. There's definitely an argument to be made. Yeah, you're creating a cushion. You're definitely creating a cushion, right, to be able to prevent future price erosion. But the problem I have with that is that you're solving off of the current NOI, and you're getting a reduction off of that on a certain multiple in today's market. But what you're not doing is solving off of a future NOI that's probably going to be lower, and likely a multiple that's going to be lower that people are willing to pay. So I guess what I'm trying to say is that you're taking risk that I'm not comfortable taking because I'm not convinced that 5 or 10% discount is going to do it in the future. And I don't want to be 10% behind the ball if I could have gotten 20% off of today's numbers, which again, remember, next year numbers are probably going to be, you're working off a lower base, right? If that happens. So it's just too early. And keep in mind too, that real estate typically moves very slowly, unlike stocks. So it takes 1 to 2 years for real estate to really bottom out in a downturn before you see the bottom of pricing, because the prices move slowly. So even if there was a normal recession and not a really bad recession, I probably would have waited about 6 to 12 months just to get some more price discovery first. So my opinion at the moment is that once the stimulus ends, probably after the election, say in January, or at least really diminishes, even though it's starting now with the second tranche of stimulus going to be smaller than the first tranche, and we're going to start to discover some of those dominoes fall. Then I'll have to wait to see all those discovery pieces and even what transactions they'll look like. I'm going to have to wait and see once the first wave of transactions of apartments sell in the first half of 2021, which takes a half a year, right? It takes months for a deal to close once it's listed. Then I'll see, okay, what do those prices look like that people are willing to pay now that things are starting to be discovered? And so I'll probably start to like dip my toe back in the second half of 2021 and then maybe more aggressively in 2022. But even then, I'll demand better than market rate pricing to reduce the risk of a continued erosion in prices going forward. You still got to be careful until you really hit the trough. So that's my kind of, long answer on the fact that I'm not doing much now. That being said, as I'm sure Raj is familiar with, there's always deals out there, and there are no-brainers sometimes. So if somebody brought me a no-brainer tomorrow, I would do it. So somebody said, here's the deal, it's 50% off for whatever reason. it's truly 50% off, I'm in, right? But short of that, you know, it's got to be a huge amount of padding to really make me feel comfortable that I can really avoid the upcoming risk.
Other question is, Jeremy, other than the returns, do you also look at splits, amount in a deal?
Absolutely, yeah. So we didn't talk about that. So great question. So one of the things I look at to meet my criteria up front is preferred return minimum and splits with the operator. You definitely want to feel comfortable that you're getting a fair deal. But the way I look at it as well is I'm really all about a win-win situation. I want the operator to be properly motivated and make sure that they're going to be interested in the chunk of money they can earn for creating profit for everybody, right? So if something's a 90-10 split in favor of investors, frankly, I'm going to be worried about it. I won't approach it like, oh, I'm going to make so much more money, because I'm going to be afraid that the operator is not going to be quite as incentivized. So I look at the splits always, and I look at the preferred return. And if they're not, either of them are not in what I consider to be a fair range, that I pass immediately. And that does help to weed things out for sure.
Let me just read here. So Jeremy, do you have a real estate professional status? If not, how do you deal with suspended passive losses, which sometimes are greater than 25K per year, as those losses are limited by IRS?
Great question. So I actually have a real estate brokerage license that I got in 2008 in California just for investing purposes. I do a little bit of hard money lending and single family on the side, and it was usable back then. It's not really, you have to get a second license now. But I am not actually full-time professional designation. And the reason is because I have an S Corp that I have consulting that goes through that I'm able to already expense everything through. So I don't even bother with that. And especially because I have so much passive stuff that frankly, like the depreciation offsets some of the other passive gains or passive positive income, I should say, that I have. So that's not really an issue for me because I'm in so many things. And some of the things I'm in, especially non-real estate, some of them don't even have any depreciation. They benefit from the negative, you know, let's say the losses that you may have on some of those real estate deals. So unfortunately, that's I'm not a good person to ask because it's not really an issue for me.
The next one, actually, it's a follow-up. Do you do 1031 exchanges, or your thoughts on depreciable die or defer strategy, and still get enough passive cash flows to sustain your lifestyle?
So can you repeat the second half of that story?
So let me read it again. Do you do 1031 exchanges, or your thoughts on depreciate, die, and defer strategy?
Oh, die and defer.
And still get enough passive cash flow to sustain your lifestyle and family on complete passive cash flow?
Yeah, great question. So I love the concept behind 1031. I don't do 1031 because most of the deals I see aren't really eligible to roll over into 1031 again, and that they're not structured a certain way up front, and the sponsors don't really offer that at the back end. I like the concept of being able to defer, like I'm sure everybody else does, but that's not realistic. And I will tell you this as well. So I'm an advisor for Realty Mogul, which is one of the, I think it's the largest real estate crowdfunding website in the US. And I've been an advisor for them since before they launched. It's been many years. And Realty Mogul looked into the possibility of offering DST structured opportunities, which would allow for 1031 exchanges. And they were going to kind of target that niche because it wasn't really being offered by other platforms. And the research that they concluded, and I don't want to speak on their behalf, but I will tell you some of the research they found, which is that a lot of the operators that and I didn't do this research, but that is what I heard. A lot of the operators that they came across had questionable experience and questionable backgrounds. And what happened is that often someone with a 1031 is very desperate to find a deal because they're on a limited time to be able to actually identify the deal to place it into on the rollover. And they found that a lot of the operators on those DSTs that allowed for the 1031s in the passive side came from like shady normal operator, you know, non-1031. And they kind of realized, okay, well, I'm going to now focus on this and I'm going to get the investors because they're going to be desperate. And so they concluded that they just couldn't find enough really high quality operators that didn't have questionable backgrounds to really make a run of that. And so, you know, ever since I saw that, I haven't even bothered, you know, and not that I was looking for it before, but that turned me off even more so. So I would caution anybody out there to be very careful and make sure you do even more due diligence on the background of the operator of a deal that is a DST type structure that allows for 1031 on the passive side. They're just very rare.
Let's keep moving along. So Jeremy, would you invest with a reputed operator syndication deal in California, but they do not buy earthquake insurance?
Good question. So I actually invest almost exclusively outside of California for higher cap rates and higher cash flow because I'm looking to maximize my cash flow. And frankly, I also like more the predictability of a less volatile market where the prices go up and down a lot because of the appreciation and cycles. I'm a very bad person to ask. That being said, the earthquake insurance here in California, in most cases, from what I understand, is the cost benefit is very hard to justify. It's very, very expensive. And so I can understand if somebody does not buy earthquake insurance. Would I do a deal? You know, it's a tough question because there is a increased risk. So either I want a little bit increased return, or I'd have to be convinced that where it's located, the probability of having a large, like if it's not near a fault, you can do this research and see that the probability of having really a major earthquake where that is probably lower than, let's say, if you're right on a fault in California. And if you understand that well enough, maybe the risk isn't that bad. And I would actually kind of equate it to, like, if you're investing in a hurricane zone and you're right on the water versus 10 miles inland, that's a huge difference as far as potential damage if you really look into it. So similar type of idea. But I don't generally invest in California, so I'm not a really good opinion on that one.
Maybe this is a different flavor of a similar question. Would you invest or syndicate in states where they have rent control issues or potential issues coming?
Yeah, great question. You know, I don't actually mind rent control necessarily if I'm comfortable with the return and I don't believe that it's going to get much worse. And I kind of say, look, you know, I may be getting a better cap rate in exchange for the rent control. But by the way, one of the benefits of rent control in certain markets is that you have more predictability of less turnover, right? People are going to stay longer. And that's actually not a bad thing for someone like me, right? Because I'm not investing for appreciation. I'm investing for predictable cash flow, but I am, of course, looking for a specific level of cash flow that I think, you know, I want to try to hit. So that wouldn't necessarily turn me off. I would be, actually, to be honest with you, I'd be more concerned about investing in a market that is contemplating, let's say, rent control, blanking, that's contemplating rent control, or, you know, you think politically hasn't done it yet, but has the risk of doing it because that can really impact property value going forward. Like, you could take a huge hit on a cap rate from 1 year to the next. If your property wasn't rent controlled and now it is, that's going to impact the multiple of people are willing to pay on the same level of income. And that's a major risk. But if you go into a market that already has all that, that's already been discovered and it's already baked in, your risk is a little bit lower on that perspective. But of course, your potential gain or your potential cash flow is limited as well. You know, and similarly, low-income tax credit deals, which are a bit of a niche and interesting to consider. I know an operator who does them, and because they're harder to manage or there's less upside, they get better cap rates. And so you got more predictability, you've got better cap rates, and as long as you're okay with the lower overall return but more predictable cash flow, it may not be a bad fit for you, you know?
I think you may have answered it, but the question came up, I don't know at what time. You talked about reading between the lines, right? I mean, can you give one example of that, Jeremy?
Yeah. So I gave one before about, if you recall, I gave one before about the occupancy rate and reading between the lines, why that is. You know, I guess the way I like to put it is sometimes I'll ask questions to really judge the way they're answered as opposed to what the answer is, right? So I may say, I'm going to give you the same scenario because it's just easy to understand, but I'll phrase it a different way. I might say to somebody, you know, the building is 97% occupied. I look at historical occupancy for the past year. It's been 97 to 100% occupied. Why are you assuming a 10% vacancy rate? And, you know, I'm just throwing that number out randomly. The answer I'm hoping to hear is, you know, the reason why we assume 10%, we still think it's going to be a high growth market. We think it's going to be 97% occupied or to 100% occupied for the next 5 years. But we chose 10% vacancy to be really conservative to set the right expectations for investors, okay? That to me is telling me, who am I dealing with here, right? And that's what you want to hear. What you don't want to hear, and that's kind of answering the question, but in the same scenario, certainly you have to ask the question anyway, because what you don't want to hear is, oh, you know, we've got 5 other apartment communities surrounding us that are all coming online in the next 12 months, and we think there's going to be a lot more supply, and we're going to have to kind of fight against the grain on that supply. That's a lack of predictability. That's a risk, and it's not something that would fit my criteria. But reading between the lines is more trying to judge, is someone conservative or not in their thought process and how they're handling things. Another way of reading between the lines is, and I love doing this, if you're able to get the pro forma and have an operator walk you through it, you can say, I see you chose 7 cap on the exit as an assumption. Can you tell me your thought process? And can you tell me what other scenarios you looked at? Okay. And so they may walk you through and say, well, we chose a 7, but we really think it's going to be a 6.5. And here's the difference in the returns. And, you know, we chose a 7. Maybe they think it's a 6, but we chose a 7. And here's the difference in the returns. You can see it's a big difference. We want to set the right expectations for investors. And now you actually learn something about both them and the property. They think it's going to be a significantly better exit. And yet now you've got a pro forma that's even more conservative than you may even thought it was. And you've got an operator that's more conservative than you maybe thought it was, just by asking the question or have them walk you through their sensitivity analysis. That to me is a little bit of reading between the lines, if that makes sense.
Jeremy, do you also invest in ground up construction of multifamily assets which are focused on capital gains, or is your focus on the cash flow?
I'm all about cash flow. I'm about predictable cash flow. I got into this type of investing for predictability, to get out of the lack of predictability of the stock market back in 2002. So I've focused on predictability for 18 years, and it's really good personality fit for me, and it's just going to continue on. I have literally never invested in 18 years in a ground up development. Not saying I won't eventually do it, but you know, the way I look at it is that my goal as a cash flow investor has all along been to get to a minimum of 3x my cost of living in passive cash flow. And anything beyond that, then you can start to take more risk, where I can go into ground development and I can get either a lower return or even lose all my money and still be okay. And so I'm actually not even there yet after 18 years, because I have kids in private school, or one kid. I live in a very expensive area, so I'm getting there. I'm actually very close. But so like everybody else, I have limited capital, and you have to be very careful with how you invest every penny. It's a really important decision every time, because once that money is gone, it's illiquid. You're not getting it back for a long time. So I've seen some tempting developments. I have not gone into them yet. I will say this: if I were to have to go into development right now, and you asked me which asset class would it be, I would say with the right operator in the right market, it would be senior living. That would be my #1 choice, because of the increased demand that's taking place. I still haven't done it, but if you had to ask me which asset class would make sense, it would be that one.
Jeremy, somebody asked, if you are an average amount investor in a deal, do you still expect the sponsor to meet you at the property site?
Great question. You know, there are some sponsors who will and some sponsors who won't. I think it's a very valid question, but I got to tell you, there's plenty of sponsors who will meet you. There are. Now, what they may say is, look, you know, I can meet you when I'm out there, meaning like they may require you to be there when they're there. So they're not spending their time and money just to meet you and going to like out of state and traveling and all that, you know, at that time. But if you're able to be flexible, you should. I mean, why wouldn't someone be willing to meet you there when they're going to be there, right? Take an hour of their time. And if they don't, I got to tell you, like, some people may think it's unrealistic. I would just move on to there's a lot of deals out there. So if you need that gut check and you want to meet the person, and by the way, one thing I will say is, once I've met with somebody once, then I'm kind of, I still want to go to the property as often as possible. I go most of the time. But if once you get the gut check done once, you can use that in the future, right? So you're not going to require that person to meet you every time. But if you're flexible to be able to go when they're there, I really don't see a good reason why they shouldn't meet you or they wouldn't meet you. And it would be a huge red flag to me if that was the case, honestly.
In fact, some of the deals, we invited people to come on for due diligence along. I mean, we were there and let people come along.
Yep.
How do I run a background check? Is there a website like what I use for tenant screening?
Great question. There are 2 websites I can tell you that I've used before. They're both very hard to sign up for, and I'll explain. Unfortunately, I'm not a good person to ask on like the more mainstream, like lower cost, random stuff you're going to find online. I use something called TLO, like Tom Larry Officer, .com. It's owned by TransUnion. It is actually hilarious. I mentioned that I used TLO to a friend of mine who used to be a police lieutenant last year. And he said, oh, that's the first thing we use when someone comes in before we even use our own database, right? The police. That's how thorough it is. That's a great website. The problem is that in order to be allowed to use it, you have to have an actual business office location. They will literally come by to your office location, inspect it to make sure it's real. They will do a background check on you, and you have to have a specific office space, like a room that has a lock on the outside that you open with a key. And then in the room, you actually have to have a file cabinet that you lock yourself. Okay, that's how seriously they take these reports, because you can run a report. I can run a report on, you know, Brad Pitt tomorrow if I wanted to. It will flag, and they'll come ask me, and they may, you know, that's illegal unless there's a business purpose. but I can do it. I can get access to it, right? They won't stop me. So it's a very, and also I get a ton of information about not just the people I run it on, but all their neighbors and all this amazing amount of information. So they take it very seriously. That being said, if you can jump through all those hurdles, and there's also a minimum cost each month just to be subscribed if you don't use it. Those are just amazing. I mean, I'll run a check and I'll get, like, I'm not even exaggerating, 60 to 80 plus pages on a person. A lot of it's not to do with them, but it could be their neighbors or other history about properties they own, who owns them now, etc. The other one I'd recommend is 𝐴𝑐𝑢𝑟𝑖𝑛𝑡, which is ACCURINT, like Tom.com. 𝐴𝑐𝑢𝑟𝑖𝑛𝑡 is owned by LexisNexis and is tapping into very similar data and very thorough as well. And it's also based on a subscription, and it's got certain hurdles to subscribe to. What I did before I had a subscription to TLO was, when I first started, I used a private investigator. Now, PIs are expensive, and what they're going to do most of the time is they have subscriptions to TLO or 𝐴𝑐𝑢𝑟INT themselves. They'll run it for you, but the real value add is not only they have access to those and you won't have to pay a subscription fee, but they'll be able to interpret the report even better than me. And if there is something questionable, they're going to take an additional step to look into it on your behalf, right? So if there was an arrest, they'll go look up the case, they'll try to dig into it further, and they'll really get to the nuts and bolts of what happened. Is this really a yellow flag or not, right? So that is value add, but they're not cheap. But in my opinion, they're a really good second option if you can't subscribe to those services. There are definitely services online that probably provide, I'm going to guess, 50 to 75% of a complete picture compared to these other services, if I had to guess. Unfortunately, I don't know which ones are out there that are good because I've never used them. So.
All right, let me look at the chat box here. And this may be, I'll let you judge, Jeremy, if it's a fair question. For a beginner who is interested to invest in passive syndication, would you recommend a crowdsourced platform like Realty Mogul? Why or why not?
Absolutely, I'll definitely answer. I'm speaking on behalf of myself and not, on behalf of Realty Mogul in this answer. What I tell people about crowdfunding, first thing you should know is I've never invested in a crowdfunding deal, even on Realty Mogul. And the reason is because I network full-time and I can find operators directly. And that's my preference, to be directly invested with them for many reasons. That being said, I think the crowdfunding sites are a great solution for certain types of people. People who are either in remote areas where it's very hard to network to find deals, people who don't want to take the time to network to find deals, because networking is really the key thing to find opportunities, or people who are too busy to network to find deals. Let's say you're in the corporate world and you're working 10 hours a day, right? So the drawback of a crowdfunding platform is a couple. Most of them act as intermediaries, which means that for the same level of risk, you're going to earn a lower return than you would if you were investing directly with the sponsor, because they're in the middle, they're a middleman, and they're taking a certain portion of the profits and some fees, okay? They're entitled to them. They're finding deals, they're adding a lot of value to you, but unless that value is meaningful to you that you're getting from them, I don't recommend them, because you're giving up some of the profits where you could be getting more profit for the same risk directly with the sponsor, right? The other challenge, of course, is that it is really hard to determine how much due diligence a platform has done. It's all internal, right? They do it, it's their own proprietary formula. So you probably want to do as much research as possible to determine how much research they've done, to see how comfortable you can get with the research they've done and how picky they are. Because here's the reality. Crowdfunding platforms have employees, they have to keep the lights on, and they have a certain incentive to do deals each year to generate more revenue, right? Which isn't the case if you're investing for yourself. So you want to be careful with that. I will tell you that to the big credit of Realty Mogul, I have seen them take many different measures over the years, and I can't get into detail about, if it was the wrong time in the cycle, instead of doing more deals and put that on the backs of investors, they would actually pivot and have other sources of revenue that were outside of their crowdfunding platform or not directly related to crowdfunding from consumers. They may have been brokering loans, they may have been brokering deals, and all kinds of other stuff, right? And to their credit, they've never really they never took the route of increasing, in my opinion, of increasing the risk on investors. They've actually done the exact opposite. The problem is, I'm afraid that's not the case for everybody. And by the way, I'm not here to sell Realty Mogul, because I don't want to influence anyone's decision about them. And I've never actually invested on one of their deals, and I haven't been on their investment committee for years, right? So just to be fair, but you're going to want to do some more research and determine who you're making a bet on that's analyzing that for you, and how much research can you do and get answers you can get from them about the deals to make sure you get to 100% comfort level of what you're investing in. All that being said, it's a great source and a great tool for the right person for sure. It provides a lot of deal flow and a lot of value.
Also, it has lower minimums, right? I mean, you can.
Yes, and actually, I would tell you another thing. Crowdfunding platforms I highly recommend for non-accredited investors, because Realty Mogul, as an example, has funds, and a couple of them have these funds that are structured in a real crowdfunding setting where you can go very low, I think 5,000 or even lower in some cases, and you can get into a diversified pool of properties, non-accredited. And the non-accredited investors are the ones who are going to have it hardest to find deals that they can actually get into, even if they do all the networking that they can. So they're a particularly good source for non-accredited investors to be able to get into very low minimums. Yeah. Those types of, by the way, I want to differentiate too. Investing in an individual deal on a crowdfunding platform is a different structure and a different minimum than investing into their funds that allow accredited and non-accredited. The funds that allow accredited and non-accredited will be a lower amount than the typical individual deals that are accredited investors only.
Let me take a look here. I think the answer here is yes, but I'll still. Do you do the same level of due diligence on a syndicator if the syndicator is a referral from a trusted friend or a colleague?
Yes, and actually I'm really glad somebody asked, because this trust but verify is absolutely critical. And if you're not going to verify, I mean, to the extreme case of that going bad is someone who put all their money in with Madoff because their friend had been with them for 10 years, right?
Yeah, I mean, if somebody asked me, I said, you know what? I mean, I trust them, but you need to verify. You don't just go by my word. I mean, tomorrow is my faith in you or your faith in me that, will go south.
Yeah,
so, yeah,
but this goes back to a couple of points we've already discussed today that are very important. A, if you do a gut check and you have a different opinion than your friend, there's nothing wrong with that, right? Because that's very intangible. You may, and I've run into that before. I've invested with people were like, no, I just not comfortable with them. No, okay, we have two different opinions. We don't know who's going to be right or wrong until 10 years later, right? So that's one important thing. You want to make sure you're comfortable with who you're making a bet on. And number two is that you may have a different box. You may have different criteria about whether that deal is really the right fit for you or not, right? That asset class could be the wrong fit. The market could be the wrong fit. The returns, you may just have a different threshold of returns, right? There's 1,000 ways to invest and none of them are necessarily wrong, but it's got to fit your own personality. So that's why defining your own box and really doing your own due diligence and determining who you're making a bet on. These are all very important things that don't work with, okay, someone just sent me a deal and I'm investing in it. It doesn't work like that.
All right, we'll take a few more. I know we're getting much more than an hour long, but we'll take a couple of more. I think this one assumes that you're using STRI. So the question is, how are you avoiding 𝐵𝑢𝑡 on STIRA, self-directed IRA?
Yeah, this is a really interesting point because I know that there's challenges with that. So when I started investing, I had the fortune of saying to myself, like, if I ever want to access the cash flow, if I go through a retirement account, I'm not going to be able to access it. So I start off investing cash instead of through my retirement account. I had a very small retirement account in the corporate world at that time because it just, in fact, the reason why is because I moved to the US in '98 as a student, got my MBA, graduated in 2000. I already had multiple years of corporate experience. And then I started building up that retirement account in the year 2000 is when it opened, right? Mid 2000. And then when I started investing passively, it'd only been a year and a half. I hardly had anything accumulated into my retirement account as an employee, even with the match. I was working at Disney headquarters and it was only been so long. So I always invested in cash and I still invest in cash to today. Had I not done that, that would have been a big problem for me to be able to access the cash, to be able to leave the corporate world. So I'm only going to look at a retirement account once I'm so big on that multiple of cost of living that I'm like, okay, not even a concern. And so I'm not there yet and I don't have one and I'm not a good person to answer that question, unfortunately. And I want to say one more thing. If it's helpful for you, by the way, Raj, I have time if you want to take more time.
Okay, that's fine then. That's fine. Absolutely. I just want to respect your time. So we'll keep going through the list of questions until I come to the bottom and it says no more questions. During COVID, what is your business strategy? Wait and see approach or still looking?
I'm always open to looking at stuff, but the reality is that unless it's just a no-brainer right now, that's the best way I would describe it, it's a pass because I'm not able to discover all those dominoes that have to fall, right? Vacancy increases, market rent decreases, adjusted NOIs or reduced profits, and then multiples on the people are willing to pay on the properties. So like I mentioned before, I'm on hold because I believe that the recession effects have been delayed. And until that stimulus is worn off, I can't start to see and discover all those important items that would normally allow me to understand when I should jump back in. So I'm absolutely on hold with the exception of no-brainers. And no-brainers can come along once in a while. In fact, I made an investment a month or two ago, wasn't real estate related, but it's just going to be rare for me to find something this year.
The next one is from Donna. Donna is asking, how do you judge if the syndicator, even though they have had success in the past, is growing too fast to manage another project well?
Good question. That's a little bit subjective. First of all, it will depend on whether they have in-house or third-party property management. I prefer to invest with in-house property management as a preference if I can, just because I feel like the sponsors can have more control over it, but that's not always realistic, and a lot of sponsors prefer the other way around. My belief is that if you're looking at someone growing really quickly and they're using third-party property management, that's going to be easier to scale, and it's probably going to present less problems if they're with a big firm, right? The in-house property management piece is a little bit different. And by the way, it also depends on whether they're scaling in one market or many markets, right? Because let's say that they're scaling really quickly and you're investing in their 10th property in Dallas. There's an argument to be made that they understand the market really well. They have a lot of contacts in the market already. They have a team in the market. And even if they're stretched a little thin, it's probably going to not go quite as bad as if you were they're scaling really quickly and they're adding, they're adding new people in 6 different markets at once, and you're the first deal in that new market, right? That's a different level of risk, almost regardless of whether they're scaling quickly or not. But then adding the scaling quickly just adds to the risk, I think, of them being able to manage all these markets at once and get the contacts in every single market and be able to actually build those relationships quickly across many markets at once. So I think part of it will depend on the exact scenario, and you have to really dig into exactly what's going on with that operator. I wouldn't shy away from someone scaling really quickly as long as you think they've got the capital behind them and the ability to scale, depending, again, on the exact scenario.
The next question, I'm just going in serial. How do we contact you, Jeremy?
Yeah, good question.
That's an easy one, right?
Yeah, anybody on here, I'm happy to help any way that I can. If you're brand new and you're just curious about this type of investing, if you're experienced, you want to network, if you're whatever it is, I'm happy to talk. So just email me. That's the best way to reach me. It's jroll, JROLL, at Roll Investments, ROLL, investments with an S.com. So jroll at rollinvestments.com.
Yeah, and that's one thing I really, really love about Jeremy. He's always available, and I know I have reached out in the past to him, and he's always made time.
Yeah, I actually want to say one thing, though, because this is live. So I will be off as of this Friday for several weeks, like for August, most of August. So if you contact me, I can definitely reply. But to schedule a time, for example, I'm probably not going to be available until the end of August. I just want to, that's very rare for me. I just apologize for that timing.
Yeah, it's good that you said that, because, last thing what people want is, hey, Jeremy said to contact me anytime, and he's not responding from his vacation or time off. That's fine.
I'll be responding. It's more like I won't be available to actually schedule a call for a while.
Okay, all right.
So, yeah.
Let's go. We did the contact you. Do you invest passively through a corporation or just under your name, Jeremy?
Great question. So, I have asked so many accountants and attorneys about this over time, and I've gotten the same answer every time. And frankly, I don't really feel great about the answer, but I've never heard otherwise. I've always heard that, look, I'm getting my pro rata, assuming that it's structured a certain way. I'm getting my pro rata portion of my depreciation and expense flow through automatically through the K1. And then as far as liability goes, if you're investing in an LLC as a limited partner or passive investor, you're limited generally to the amount that you initially invested. You can't be forced to put more money in. You're not going to take additional liability on if the entity gets sued. And of course, this is just my understanding. You're going to want to talk to your attorney and your accountant about this for sure. But because that's the feedback I've received, I've always invested personally. There's really, to me, I've seen no reason to not invest personally for those two reasons. It just flows back to me, and I don't really have any additional liability as a limited partner.
That's perfectly right. Bob wants to know, are you leading a group of investors? Can you tell us a bit more about it?
Yeah, so it's funny. I talked to Raj about this before the webinar. So if you contact me directly, I can tell you more about it. What I don't like talking about it in big groups because I'm not allowed to publicly solicit investors. So in fact, if you look at a website, I don't even have a website. I never on a podcast ever mention my investor group beyond what's in my bio when they read it, because I just don't want anyone ever saying that. It's one rule I have for the person who's interviewing me. And so I literally said the same thing to Raj earlier. So if you want to contact me, I can give you more information about it, but I want to warn you, it's really more of a secondary focus for me, so it's low volume. I've only sent one deal a year to my group for the past 3 years, and that could have been 0 and it could have been 2. It's just I only send a very small subset of what I'm investing into my group, and it's also because I'm very picky. In a better part of the cycle, let's say like in a couple of years, it might be 2 to 5 deals a year I send to my group, but I'm happy to talk to you about it offline. I just don't want to discuss it in more detail on the webinar if it's okay.
We respect that, Jeremy, and thank you for sharing that. Okay, what percentage of Jeremy's, again, Jeremy, if there's a personal question you don't want to answer, just you can say,
sure.
What percentage of Jeremy's portfolio is real estate versus non-real estate? And within real estate, what's the slice of various asset classes?
Okay, so, so I'm trying to figure out how to answer. It's not a privacy problem because I think it's an important question. It's more like, when you, I guess I would like to know if, when they say percentage, is it, if I looked at each deal as a slice, is it the number of deals or is it actually the dollar allocation? You understand what I'm saying? But so I could tell you that I'm in about 10 startups. And that to me is something I do if it's like an absolute no brainer. I have to make a bet on a specific person. So it's really rare. I'm not looking for them. The problem is, like, as I mentioned, I invested in one startup. In fact, just today Wednesday, Tuesday. Okay, so just yesterday, I closed on selling some shares in the startup that I invested in, which some of you actually may know, which I'll mention in a second, where I literally got like 76 times on my shares, which is crazy. I was the first order ever on the site. I invested in the seed round, and in fact, it was actually one of the people in my investor group was the founder, and I just had to make a bet on him. Just a really smart guy. Have you actually heard, Raj, of Thrive Market?
Mm-hmm.
Yeah, so it's Thrive Market. So I was the first order ever on the site. So it's still going and it's still growing. I just took some money off the table. So when you look at it that way, like that became a disproportionately large percentage of my net worth as a result of that. So I'm trying to like pare some of that back. So I have some weird situations with that kind of stuff, right? Another startup I have that's a similar situation. It's a company called Start Engine, which is the biggest equity crowdfunding non-real estate website in the US. So again, seed round investor, I had to make a bet on someone, a co-founder was in my group and I just had to make a bet on him. So from that perspective, I'm kind of like in the middle of trying to sort all that out and get some money off the table from some of the stuff that's grown a lot. From just a pure number of slices, which is probably a better way to look at it, the vast majority of my investments are in real estate. I do have some non-real estate stuff as well. I have some ATM machines, I have some oil and gas, I have a little bit of like debt, consumer debt related investments. There's other stuff too, but my strong preference is being an experienced operator, stabilized, like 80 to 100% occupied, diversified tenant base. I call it commercial real estate, which includes multifamily, student housing, multifamily, but larger properties. So I typically invest in stuff that's 10 to 25 million in purchase price. There's a lot of tenant diversification. And so the vast majority of my investments are in real estate.
I think there's one more, and then I'll ask my question after that. So where is a good platform to find deals for someone who doesn't have a great network yet?
Yeah, great question. This is a question I get all the time. Look, if you're looking for an online platform, the best place to find deals, because there's deals right now, is all the crowdfunding platforms. If you want a real plugin, again, that's an intermediary, and you have to be an accredited investor to be able to participate in most of those, but it's definitely a lot of value if you're willing to take a slightly lower return in exchange for similar risk versus finding stuff directly. Some people go on to BiggerPockets, which is the largest online real estate community in the US. The problem with BiggerPockets is a couple things. Most of the investors on there are active or kind of, and they invest in single family or very small, like few unit multifamily deals. So most of them are not passive syndication investments, but you can go on there and post up and say, I'm an investor, I'm looking for multifamily deals. No operators respond. I don't want any sales pitches. What investors have any suggestions? The problem is you really don't know who is responding. Like, I'm afraid a little bit of sales pitch problem with that, right? Another thing you could do is definitely go on to some either meetups and or podcasts and listen to who's on there and see if it's worth contacting. That's another somewhat efficient way of looking for deals these days. You can also connect with investor groups. There's a lot of investor groups now whose really business models to find deals. But again, in most of those cases, I don't do this in my group, but most of them are pooling people into LLCs and they become an intermediary. So it's the same concept as a crowdfunding platform where they're taking a bit of a portion of the profit. What else? There's some conferences that are very good for networking. Now during COVID, that's obviously a challenge, but there's a couple of large conferences, several in the US, where like if you spend 1, 2, 3 days there and a little bit of money and time, if you're able to, it's very efficient. Like I actually, I usually don't like mentioning it, but the nonprofit that I started, For Investors by Investors, we co-host a conference in LA every year called Intelligent Investors Real Estate Conference. We had about 300 people last year in LA. Now it's going to be virtual for January 2021. It's called IIREC. You can look it up. But the one that I always recommend to people with the biggest critical mass every year is typically the Best Ever Conference in Denver, which I think this year in February, I was there. I think there was maybe 800 people. So, you know, look for a big critical mass, and that could be very efficient. And it's even easier to attend those now because it's going to be online for a little bit. The challenge with attending those online right now is that the networking is much more difficult. And I could tell you that I'm sure some of the other organizers, like the #1 focus we have for our conference next year, and I had a call that yesterday, is how do we maximize networking, knowing that it's the hardest piece for someone to achieve online as an attendee. And there's tools we can use and stuff. So there will be some networking. So those are some ideas. You know, to be totally honest with you, I've been networking for 18.5 years. It's still the hardest part of my day, finding opportunities. Almost every time I find a deal, it's through some component of networking. And if you want to be a full-time passive cash flow investor and you really don't want to have to go through intermediaries, it's going to be your #1 job is networking. And it's a very important piece of this.
Actually, that brings you to my question it's a good segue is, what does a day in life of a full-time passive investor look like?
Yeah. In all fairness, it's a little bit different for me because I have an investor group, so it's not like quite as clear cut, but I'll tell you some of the stuff.
Do you do kind of daily research? Do you read something on a daily basis?
So one of the most important things I do, and I do it every day, is I read about 2 to 3 hours a day of news. And one of my goals is to read a lot of sources that get out of the weeds of the media and the actual data. You know, not what the media is saying, but what does it actually mean? What's actually going on? I'm going to give you guys a really good resource as an example. You ever heard of Shadow Stats?
Shadow Stats.
Yeah. Shadowstats.com. Great website.
Might have heard of it.
What Shadow Stats does is for inflation numbers, as an example, and they do this for multiple different things. You know, right now, the way the government calculates inflation has changed over time. And the CPI they measure is conveniently 2 to 3% or whatever number it is. Mm-hmm. But if you calculated the inflation the way it was calculated before 1982, it would be significantly higher. I'm talking about 6 to 8%. Okay. They tweaked it in 1982 just to make the numbers look better so that it wouldn't it would look like it's under control. So Shadow Stats takes a lot of this data and shows you the way it used to be calculated and what the more accurate real numbers are as an example, right? And why that's important as an investor is because when you're targeting certain returns for yourself, if you're not keeping up with the real inflation, you're falling behind. So forget CPI, you've got to know what the real inflation is and keep up, right? So that's an example of stuff to look at. But I do literally 2 to 3 hours of reading every day. And part of my reasoning for that as well is not just getting out of the weeds of the media. It's when I invest in a deal, because it's illiquid, and often I invest on a 10-year horizon in terms of the projected timeline, I've got to anticipate way ahead the consumer trends, what the risks are, and which asset classes I think are going to have the most predictability for 10 years. The easiest example I can give you is if you would have invested in a Best Buy anchored center 10 years ago, you may have a problem today. And there's a lot of examples of that, right? And especially now with retail really going down. But if you could have foreseen that or thought ahead on that, that would be very helpful. What I'm kind of grappling with today, and this is going to sound a little out there, but 10 years from now is a long time from now with technology, right? So, and you can appreciate, you were in tech before, flying drones, okay, they're transporting 4 or 5 people are probably going to be reality in 10 years from now. And what does that mean for the location of office space, of retail space, of even apartments? Like, what does that mean, you know? Self-driving cars, does that mean that someone's going to be willing to take a longer commute to work and not worry about the fact that their office building isn't as close as it used to be because they don't mind being in the car, right? Self-driving cars, how's that going to impact Domino's Pizza's 50 locations in Los Angeles if they can have one unified location in a little industrial area and they're putting pies into cars and they don't need the other 49 locations in the strip center you're about to invest in? Are they going to be there in 8 years? Right? So just constantly goes through my mind to be able to determine which are the most safest asset classes from you for predictability. But unless you're thinking really far ahead, I find unfortunately a lot of investors don't think far enough ahead in terms of the real timeline and where the pitfalls can be, but you don't really have that information unless you're reading news all the time to really keep ahead of what's going on. So I think about all these things all the time, the data, the trends, to try to avoid some of the pitfalls going forward. That's a very, very important part of my day. The other parts of the day are a lot of networking, deal review, try to meet new people to assess new operators, network with other investors to trade information about operators, which can be highly valuable about their experience with operators and vice versa. And just a lot of networking essentially.
That's great. Let's see. I think one question just popped up, and we'll call it as the last question because I don't see anything after this coming. What asset classes are you predicting right now in this scenario, and what do you feel about the hospitality sector, Jeremy?
Good question. So I have never invested. The only asset class I've specifically not invested in ever, as I've just been not open-minded to, is hotels. And the reason is because the average daily rate changes every single day, and the predictability just is not there for me, right? It just doesn't equate. Now, some people are looking hotels right now and saying, wow, this is complete carnage, I'm staying away from it. Other people are looking at it, wow, this is a big opportunity. I want to buy that hotel at 25 cents on a dollar. I'll wait 2 years and then it'll open, and that's going to be a huge windfall, right? Or I want to buy that hotel. I just spoke to somebody yesterday. I want to buy that hotel and repurpose it as a senior living facility. It's going to cost me 25 cents on a dollar, and my cost base is going to be much lower than buying a senior living facility, just as an example, right? So a lot of different things you can do with it. I am not doing that because that's not my risk profile, but that's my opinion about hospitality. It can be completely not make sense for some people and be a huge opportunity for other people right now. What I will say as well is that my favorite asset classes for the next 10 years, based on predictability, in my opinion, are mobile home parks, self-storage, apartments, and senior living. I'm not saying any of those make sense for me right now. I'm not saying any of them make sense in a random location. And there's a lot of other factors. But if I'm looking at predictability of cash flow, those are my favorite picks for the next 10 years because I see continued demand for apartments in the right locations. I see increasing demand in senior living facilities in the right locations. I see increasing demand for mobile home parks, which, by the way, the supply is reducing every year of, and demand's increasing of for the next 10 years. And self-storage in the right locations, especially the southern states where people are going to be retiring, I see people potentially needing to store some of their stuff at a lower cost because they can't afford the large enough house or the large enough apartment building as they're retiring. So those are my four favorites, kind of tier A for the next 10 years in the way that I invest.
Great. Well, Jeremy, it's been 90 minutes already, and I think I have seen people just stay on for complete 90 minutes. Generally doesn't happen after, I see after people dropping after an hour, but this was extremely valuable, so informative. And like Jeremy said in the beginning, everybody's different, every investor is different. Jeremy has his own set criteria. Predictability is very important to him. Cash flow is very important to him. You may be a bigger risk taker than Jeremy, so take that everything with a grain of salt. But again, tons of great information here, and I'm sure I will go back and listen to this again like I do for every Jeremy's interview. So thank you so much, Jeremy, for taking this time and adding so much value to the audience here.
Oh, no problem. Thanks for having me on. I just hope it was helpful for people, and yeah.
Thank you, Jeremy. Thank you.
All right, talk to you later.
Good night, everybody. Take care.